In January, the market rebounded harder than Wilt Chamberlain, which means we investors need to bust out the shovels and dig deep for those discounts. Luckily, I've stumbled upon 3 dividend stocks whose share prices still look attractive despite what the rest of the market is doing, and in this video, we'll be talking all about them and why they might be good pickups in the month of February. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. And also leave me a comment below and let me know which stocks you have your eye on. I'd be curious to hear what you think is looking good. All right, now jumping into the 3 stocks of the day. The first one we're going to be talking about is Innovative Industrial Properties, ticker symbol IIPR, which is the pioneering real estate investment trust for the cannabis industry. And what they do is buy specialized industrial real estate properties and lease them out to operators in the industry who, because of the nature of their business, would otherwise have trouble getting financing and a place to operate. And IIPR has built a very solid business doing this with very aggressive revenue growth these last few years, along with a similar trend here on the bottom line, the adjusted funds from operations, but the stock share price is still crashing down. In the last year, their share price has really come tumbling down and has seen losses of nearly 56%, and just in the last 30 days, they're also seeing double-digit losses of near 15%, and it looks like in the last month, their share price really dropped off here sometime mid-January, which came about after the company released an end-of-year update to their portfolio of properties that revealed lower than desired rent collections and various tenant issues. Specifically, a percentage of their tenants are either in default, receiving deferrals, or are looking to restructure, which is one thing to keep in mind with this company. While IIPR isn't directly in the cannabis industry, their tenants are, and this stuff isn't even federally legal yet, which poses a myriad of problems for their tenants, which in turn exposes IIPR to a substantial amount of risk. Having said that, there's still a chance that this news could be overblown, in which case IIPR is looking extremely discounted and prime for purchase. Looking at the valuation page, Seeking Alpha is giving them an overall valuation grade of an A, which is fantastic. And if we scroll down to the bottom here and look at their P to FFO, it's sitting at about 11.5, which is nearly 20% lower than the sector median. In terms of the dividend, Seeking Alpha is also giving them pretty solid grades. They get an A for safety, an A for growth, an A for yield, and a B for consistency. And scrolling down, just looking at some of these numbers, we can see they have a very high forward dividend yield, sitting just above 8%. Their 5-year growth rate is off the charts, nearly 67%, and they've been growing this dividend for the last 5 years. Now, obviously, the dividend stats are looking pretty good, but there's still some risk here with IIPR, and having said all of this, it begs the question, is this stock a buy right now? And if we refer to the intrinsic value calculations on alphaspread.com, it does appear to be undervalued. They give Innovative Industrial Properties a worst-case intrinsic value of about $114 per share, which would make it about 22% undervalued. They give it a base case of $140.84, which would make it 37% undervalued. And best case scenario, they give Innovative Industrial Properties an intrinsic value of $211.32, which would make it nearly 60% undervalued. So that all looks pretty good, but it's important to keep in mind, guys, to take these numbers with a grain of salt. It's all very subjective and everyone does these calculations differently. And so I think really the big question surrounding this stock when considering adding it to your portfolio is whether or not the risk that comes along with this very volatile industry and also very young industry is going to be worth it for you as the investor. If so, then I think right now looks like a pretty good time to buy some Innovative Industrial Properties. Anyway, moving on, the next stock on our list to talk about is Pfizer, ticker symbol PFE, which is a company that needs no introduction. They've certainly been in the news enough these last couple of years for obvious reasons. Now, because Pfizer was such a big beneficiary of the pandemic, its share price went from being somewhere in the mid-30s to a peak of about $61 per share at the end of 2021, which is a huge jump. And since then, it's been making its way back down to earth slowly but surely. And in the last year, Pfizer has seen a share price loss of about 13.3%, and most of these losses have come in the last month, where they're down a whopping 13.25%. And I couldn't find anything super specific to indicate that there was one big crazy thing to cause this huge drop off in share price, but some of the recent articles surrounding this company include talks of COVID in general becoming considered more like the seasonal flu, which could have an impact on Pfizer's COVID sales, which has really given their revenue a nice boost these last couple of years. But when talking about this company, it's important to remember that outside of the COVID shot, Pfizer is still one of the world's largest pharmaceutical companies and still makes other very popular products like Advil, Viagra, Xanax, and Zoloft, just to name a few, and over a long period of time, the company is likely to continue growing. Now, in terms of valuation, just like the last stock, Seeking Alpha is giving Pfizer an overall valuation grade of an A, and all 3 of the big valuation metrics are looking pretty good for this company. Starting with the PE ratio, this is sitting just under 7, nice and low in the single digits, which is 66% lower than the sector median, and it's also about 41% lower than the company's 5-year average PE ratio, which is a big difference. And then scrolling down, taking a look at the price to book, this isn't too terrible, 2.6, which is right in line with the sector median, but this is also about 23% lower than the 5-year average. So once again, a very big difference there. And last but not least, the price to cash flow, 6.66, nice and low in the single digits, but it's also 63% lower than the sector median and exactly 50% lower than the 5-year average. So looking at all three of these metrics, it tells us that Pfizer is considerably more discounted than where they've historically been these last 5 years. And the dividend stats on this company are looking pretty solid. I mean, the 4 dividend yield's 3.65%. They have a very low payout ratio, 24.4%, which indicates that the dividend really isn't stressing them out too much, which should indicate further growth. And on that note, the 5-year growth rate is about average 5.7% with 12 years of consecutive dividend growth. But if we look at the dividend history page, we can see that their record of just consistently paying the dividend is much longer, with 33 straight years of dividend payments. Now moving over to Alpha Spread and looking at their intrinsic value, Alpha Spread gives Pfizer a worst case value of $39.34, which would actually make them still a little bit overvalued by about 13%. And they give it a base case intrinsic value of $55.14, which would make it nearly 20% undervalued at this point. And they give it a best case value of $98.36, which would make it 54% undervalued. And that's an extremely generous intrinsic value, I think. I don't see Pfizer getting that high. But anyway, moving on, this brings us to the last stock of the day, where we're talking about CTO Realty Growth, which is a real estate investment trust that owns a portfolio of high-quality retail-based properties across the United States, with some of their more notable assets being West Broad Village in Glen Allen, Virginia, Ashford Lane in Atlanta, and the Shops at Legacy in Plano, Texas. And I've got to give a shout out to my man Dividend Dad in the Discord group for showing me this one, because it looks like a really awesome high-yield REIT at a really great price. Now, in terms of share price, CTO hasn't done anything crazy in the last year. They're only down about 5.4%, and they're actually up in the last 30 days with a gain of 2.3%. And if we look over at the right-hand side of the screen, this leaves them with a P to FFO nice and low, almost in the single digits at 10.76. And the financials for this real estate investment trust aren't too shabby either, guys. Taking a look at their income statement here, if we pull up this chart, we can see that for the most part, it's trended upward. It looks like there was a little drop between 2016 and 2017, but since then, they've done nothing but grow this revenue up and up. And if we scroll down to the bottom, looking at their adjusted funds from operation, right here, it's not listed for most of the last 10 years, but from 2018 to 2022, overall, there's definitely still some growth there. And it looks like the last couple of years, 2020 and 2021, were a little bit flat, but this was due to a higher level of property expenses. And one unique thing about this real estate investment trust that we don't see too often is this company is actually buying back shares, or across the last 10 years has historically bought back shares. It looks like they did bump it up here between 2020 and 2021. Typically, we see them issuing more shares and see those shares outstanding increasing over time, because that's what many of these REITs use to finance their deals and make more acquisitions. So it's kind of interesting to see CTO buying back their shares. And now moving on to the dividend stats, while normally we'd look at this on Seeking Alpha, the company's own investor presentation here actually has some fantastic info on the dividend that we'll be referring to. First and foremost, we can see that they have an annualized dividend yield of 8.3%, which is incredibly high. But some other notable things about this company's dividend, they have 46 consecutive years of just paying this dividend, and they've also grown it in each of the last 10 years. And still on the topic of dividend growth, if we look at the chart here on the left-hand side of the screenshot, we see some very aggressive growth in that dividend these last 3 years, where they've been able to increase it by more than 64%, which is insane. And in 2019, they were only paying 12 cents per share for the dividend compared to 2022. This was over 10 times higher at $1.49. Now, in terms of whether or not CTO is a buy right now, Alpha Spread still thinks that they're pretty undervalued. They give them a worst case intrinsic value of $21.09, which would make them 12% undervalued. They give them a base case of $26.73, which would make them 30% undervalued. And they give them a best case intrinsic value of $40.59, which would make them 54% undervalued. And this would be insane, guys, considering the highest the stock has ever been is about $22.50. So like I said earlier, take this with a grain of salt. All right, guys, now with those three stocks behind us, there's still quite a bit more that I think you need to be on the lookout for as we move into February. And the first one is going to be Walgreens Boots Alliance, WBA, who is down 6.73% in the last month, and they've seen a drop in the last year of 31.6%. I also think you need to look out for Microsoft, who is up a little bit in the last 30 days, but still across the last year, they're down a whopping 18.4%, which is a big drop for Microsoft. Next up, guys, keep your eye on Kroger, ticker symbol KR, who's down 3.5% in the last 30 days, and in the last year, they're down 7.1%. But look on the right-hand side of the screen, that PE ratio is pretty low, almost in the single digits, just below 11. Next up, keep your eye on HPQ, who has seen a big jump in the last 30 days where they're up 6.3%, but in the last year, they're still down over 20%. And next up, you guys know I had to bring bring this one up. Tyson Foods, TSN, who's also seen a very big jump in the last month, 6.8%, but they are still down nearly 30% in the last year. So definitely look out for Tyson Foods. Another one to keep your eye on is Stanley Black & Decker, who, man, this is such a big gain in the last month, almost 20%. But guys, remember, they are still down almost 51% for the year. And then we got VF Corporation with another double-digit gain of 17.5% in the last month. But just like Stanley Black & Decker, they're down over 50% in the last year still. And you guys know I also had to bring this one up. Medical Properties Trust, who despite their whopping 23% gain in the last 30 days, is still down 41% in the last year. So definitely discounted, and they have a low single-digit P to FFO of only 7.6 still. And then next up, we've got KRC. Keep an eye on this one, who, unlike many of the other stocks we've seen, is down in the last month, down 2%, which leaves them with a loss in the last year of near 40% and a very low P to FFO of 8.3. And then the second to last stock you need to keep your eye on is Verizon, who's up about 3% in the last month. Nothing too crazy, but they're still down 25% in the last year. And they also have a very low PE ratio of 7.65. And then last but not least, guys, you gotta mention this one. Keep your eye on Intel, who is up about 16% in the last month, but still, and this will come as no surprise, they are down over 42.5% for the year. And now that you're clued in on some of the best stocks to buy as we head into February, if you want to see which stocks I'm holding, then check out this next video right over here where I'm revealing my entire dividend stock portfolio. That's right, guys. In this one, I'm showing you every single stock in my portfolio and how I've been able to beat the market for the last 2 years in a row. So click right over here to check it out, and I'll see you in the next one.